Welcome back. We'll now do a small exercise on the previous two chapters, chapter 8 and chapter 9, that is working capital assessment, fund based and non-fund based. So the first question is, working capital is required because one, cash conversion is instantaneous, or two, cash conversion is not instantaneous. So if you recall, we discussed this already, right? So there's something called an operating cycle. If you purchased raw material, okay, say a company has purchased raw material. Now this raw material will be put into a production process, so it gets converted into what is known as work in progress. So some processing goes on here, and it will be finally converted into what is known as a finished goods. Okay. Now this is not something that will be sold instantaneously, right? So again there will be some time for sale. So till that time it will be in the go down as a finished stock, right? Then it will be sold, right? But once we sell the product, immediately we won't realize the cash, okay, because we will give some credit period to a customer, right? So after the credit period only we'll be getting back our cash, right? So finally we end up with the cash, right? This is the cash which we started to purchase the raw material, and again it has come back after some period, okay? So this period we already discussed is known as operating cycle. So working capital, right? We require working capital. Why do companies require working capital? To finance this cycle, right? Because cash conversion is not instantaneous. See, if you had put 1 rupee, into this cycle, you pumped in 1 rupee into this cycle. To get back this 1 rupee, the money has to go through the entire cycle. It's not instantaneous. It will take some time, right? Because there's a time involved in conversion of this raw material to work in progress, right? Because there is time involved in each and every step to purchase raw material, to place the order, to get the material, right? And we need some buffer stock, right, in the inventory for a safety purpose. So that will consume some money, right? The raw material will be put into the raw material will not be immediately converted into finished good. There will be some work in progress because it's a process activity, right? And the finished goods will be in the godown for some time. Then the customers will not pay you instantaneously. So this cycle is what necessitates the requirement of working capital for any company. Now this cycle we discussed is known as the operating cycle, right? It might vary from 2 months or 3 months, 1 month. For some industries it might be more than 6 months, we don't know, right? But the point is the cash conversion is not instantaneous. Had it been instantaneous, like on day 1 I put some 1 crore into the starting process, right? I purchased raw material, everything in a jiffy. In one single day, the cycle was complete and I got back the cash. So in that case, I would not require any working capital limit from any bank, okay? I would not require any working capital because the cash conversion was instantaneous. I required this because my cycle is prolonged, right? It's more than say 1 month or 2 months. That's why we require working capital. So the answer to the first question is cash conversion is not instantaneous. That is why we require working capital, okay? So the second question, which of the following is not a reason, okay? Which of the following is not a reason for maintaining raw material stock? So why do companies maintain raw material stock, right? For example, a company is consuming 10 tons of iron ore every day. Every day it's consuming 10 tons of iron ore, right? Then there is this go down here. Now the company is keeping some stock of iron ore, some 200 tons. The question is, why do companies keep this stock? Why not don't keep any stock, right? As and when you require 10 tons, because today is the production process, you ask the supplier to supply 10 tons today morning, right? So today the production process completed. At the day end, you are left with no stock, right? Next day morning, you ask the supplier again to bring in 10 tons, right? So there is no need to maintain any stock. So why are companies maintaining this raw material stock? So if you see, we already discussed this also. So there is a time lag between placing the order and receipt of material. This is the reason why is one of the reasons why companies maintain stock of raw material. There is a time lag between the order and the receipt. It's not like if you place the order immediately you get the material. So there is a time lag. Then there is an uncertainty in the supplier end. Let's say, for example, that the plant of the supplier was shut down due to extraneous factors, and he was the only supplier to us. We depend on him. So what if something happens and the product and he couldn't supply? Then our production will be stopped. We want a hand-to-mouth existence, okay? Right? We need some safety stock, okay? Price discount is also the reason why companies maintain stock, in the sense that they purchase in bulk so that they can avail price discount. It is a common practice by the competitors. So this is not a reason why we maintain stock. Just because the competitors are maintaining, we don't maintain, right? That is not a reason. So because of these 3 reasons, the first 3 reasons, companies maintain stock of raw material. So which is not a reason, we can say this is the the fourth one. The third question, the time between injecting cash into the system and getting back the cash is known as, right? This we discussed in the first, while we were discussing the first question, right? This is known as the operating cycle. Supply cycle, demand cycle, turnover cycle, cash cycle, right? Those are not relevant. So operating cycle. This is a cycle. This is the time period required between. This is the time period involved in getting back the cash. Once we inject into the system and when we are getting back, this entire period is known as the cash. Is known as the operating cycle. Portion of current assets financed from long-term sources of funds is known as what? Again, we discussed. Please refer back to the section where we discussed NWC, right? So there we said that NWC is a portion of current assets that is financed from long-term sources. So NWC is the answer for this question. Fifth question, NWC is always a positive figure. True or false? Not necessarily. NWC can be negative, right? We discussed this. NWC can be negative, which implies that current ratio is less than 1. Okay. Please recall this discussion also when we discuss NWC. NWC can be negative. What does NWC? A negative NWC imply that short-term funds were diverted for long-term uses. Okay, so NWC can be negative. So NWC is always a positive figure? No, it can be negative. The sixth question, fill in the blanks A and B in the following table. So let us see this table. So current assets is 100 lakhs. Creditors other than bank finance is 30 lakhs. So what is the working capital gap? So please refer back to that the assessment of working capital where we discussed the turnover method. First method of lending, second method of lending, there we discuss this, right? So working capital gap is nothing but this minus this, 100 minus 30, this is 70. Working capital gap is the difference between the current assets, what is the total current assets requirement, and what are the creditors other than bank finance. See, this current assets, this we discussed, right? Current assets will be financed by three parties, we said that. One, the major party is there should be some margin, the borrower's margin, or let us say the long-term funds. Not necessarily margin, long-term funds, okay? That is NWC. Then it will be, a part of it will be forwarded with the bank in the form of CC. A part of it will be financed by the creditors. So to get the total current assets requirement, the total current assets will be financed by these three parties primarily. So if you want to find out what is the bank finance we want to give, so first of all we have to deduct this and this, right, from the current assets. Current assets minus your creditors and NWC. So only the balance the bank will finance. Right, isn't it? So current assets minus creditors, this portion is known as current assets minus creditors is known as working capital gap. Right? From the working capital gap, we then deduct the NWC. See, from 70 we deduct the minimum NWC. What is the minimum NWC? 25% of current assets for a large company. Okay, so 25% of current assets, that amount has come to 25% of current assets. So now 70 minus 25, 45 will be the bank finance. So the answer is 70 and 45. Right? Then the next question. Question number 7. I think there is a mistake here. None of the options are correct. Actually, we need one more option, right? 50 lakhs. So basically, this company is consuming raw material of 20 lakhs every month. Okay, per month, the company is consuming raw material of 20 lakhs, and this company wants to maintain raw material stock equivalent to 2.5 months of consumption. In the sense that today, processing is going on in the factory, right? The company is consuming some raw material, right? Then there is this go down. The company wants a buffer stock here, buffer raw material, right? This raw material should cover the raw material requirement for the next 2.5 months, right? So at any point of time, the company wants its go down raw material worth 2.5 months equivalent of consumption. So since every month it is consuming 20 lakhs, it means that 20 into 2.5, at 50 lakhs, the company should be maintaining 50 lakhs worth of inventory, 50 lakhs worth of raw material in the go down. If it has 50 lakhs worth of raw material in the go down, what it means is for 2.5 months the company can draw raw material from this go down, even though no raw material arrives from the supplier. Even if for some reason the raw material from the supplier were to get stopped, still the company can survive for 2.5 months. Still the company can continue its production process for 2.5 months simply by drawing from its buffer stock. Okay, so if a company wants to maintain 2.5 months equivalent of consumption of raw material, it has to maintain 20 into 2.5, that is 50 lakhs worth of raw material. So there is no option here. It's actually a mistake. This is 50 lakhs, right? The 8th question, finished goods holding level. What is the formula? Closing stock of finished goods into 12 by what is this? So this we discussed. This is cost of sales, right? Work in progress holding level will be cost of stock of work in progress by cost of production. In that case, it will be cost of production. So please refer back to this concepts which we already discussed. So the next question, question number 9, the assessment of working capital under turnover method is based on the logic that the working capital limit should be at least what percent of the annual sales. Again, refer back to the section on turnover method. There we discussed the answer is 20%, right? So what we said was the total Turnover method assumes an operating cycle of 3 months. Okay, so in other words, we can say that 25% of the turnover will be the total working capital requirement. Out of this 25%, 5% will be the borrower's margin, 20% will be the bank limit. Right. So the working capital limit should be at least 20%. That is the logic of turnover method. This is actually applicable for small borrower accounts, say 5 crores. It depends on the bank policy. Usually for banks, usually for small companies, availing limits below say 5 crores, turnover method is applicable. So the answer is 20%. Question number 10, if the actual NWC available in the system is 35 lakhs, calculate IBBF in the following case. So in this case, current assets is 120, current liabilities other than bank finance is 50. So working capital gap is obviously 120 minus 50, so 70. Out of this 70, right, the borrower has to bring some minimum NWC, and the balance bank will be financing. So then minimum NWC has come to 30. So the bank can sanction up to 40. But recall that we also discussed that in case the actual NWC happens to be greater than 30, this minimum WC. So here in this case it's 35, right? In that case, the bank's contribution will come down to that extent. Since 5 lakhs is additional NWC already available in the system, over and above the minimum NWC, so it gets reduced from the bank finance. So 35 will be the IBBF, not 40. See, the calculation might seem to suggest that the bank finance is 40. That is correct, but that is on the assumption that the borrower has NWC of only 30 lakhs. That is the minimum NWC. In case the actual NWC available in the system is more than that minimum NWC, automatically bank finance will come down. The logic being that because 70 lakhs is the working capital gap, whoever finances the 70 lakhs, they can be it can be bank and the borrower NWC put together, right? The creditors are already included here, right? Current liabilities other than bank finance. So this 70 has to be financed by a bank and the NWC. So whatever may be the combination, it should not exceed 70, because in that case we will be ending up over financing the company. So if NWC happens to be 30, then bank can definitely give 40. In that case, this will be correct. But because NWC in this case is 35, if bank extends 40, it will be ending up 75. So that will be over financing. So because 35 is already available, we will reduce that 40 by 5 lakhs and finance only 35, so that the total will be 70. Right? Got this? So the answer is 35 lakhs. So question number 11, NWC of a company as on 31/3/2013 was 150 lakhs, right? For the year 2013-14, long-term sources of funds was 425. Okay, so long-term sources, this is sources, long-term, short-term sources, long-term sources. So this long-term sources is 425 and short-term sources was 370. Similarly, uses is saying that the long-term uses is 480, short-term uses is 350. Now the question is asking what is the NWC as on 31/3/2014. So last year the NWC was 150 lakhs. What is the NWC this year? So this is a tricky question, but I think if you have followed the discussion which we had on diversion of funds, where we drew up that funds flow statement, if you are clear on that, this shouldn't be a problem. If you are unable to solve this question, doesn't matter. It's just, we already discussed that this is a NWC. In fact, is a slightly complicated topic. It will take time to digest. No problem. This company he was able to raise long-term funds of only 420. Sources of funds means the sources, right? The money coming in. So the company could raise only 425 lakh of long-term sources. What are these long-term sources? It could be capital, it could be bank term loans, whatever, right? But whereas the long-term uses was 480. Long-term uses in the sense that land, plant and machinery, investments in group concerns, share market and all this, right? So while the long-term sources was only 425, the company has a long-term uses of 480. So there is if you calculate, there will be a 55 lakhs deficit. The company has got a 55 lakh deficit on the long-term front. Only 425 lakhs of long-term sources, whereas it spent 480 on the long-term uses. So 55 lakhs was deficit. From where did this 55 come? From where did the company get this 55 lakhs? Short-term funds. See, the short-term sources was 370, whereas the short-term uses was only 315. Here we got 55 surplus, here got 55 deficit. So this surplus, right? What is this 370 short-term sources? It could be CC, it could be creditor, short-term sources. Whereas the short-term uses was only 315. The increase in inventory, increase in debtors, no, short-term uses was only 315. So whereas the company was able to raise funds from the banks and creditors 370 lakhs, it could spend only 315. The requirement was only 315. So it is having surplus short-term funds of 55 lakhs. So surplus short-term funds of 55 lakhs. That got diverted to long-term uses. The long-term uses, the long-term funds was not sufficient. 55 lakhs deficit was there. That was bridged by short-term surplus. So this company was having a short-term surplus and long-term deficit. So this 55, whether you call it long-term deficit or short-term surplus, both will be same, 55. So this 55, if you understood the concepts pretty clearly, you'll find the answer to this question very easy. The linkage comes here. This 55 is nothing but the decrease in NWC. Why this is so? Go back to the chapter which we discussed on diversion of funds. This 55, this long-term deficit, or in this case the short-term surplus, this is nothing but the amount by which the NWC has decreased. So last year it was 150. So this year the NWC must definitely have come down by 55, 95 lakhs. Tough question. Doesn't matter if you couldn't solve it, but that is the concept, right? Question number 12. In LC mechanism, when the seller submits proof of shipment to his banker, right? So we discussed there is a buyer and a buyer bank. We took the example of SBI. Then there is a seller, foreign party, and there is a Deutsche Bank. So when the seller submits proof of shipment to the banker, so SBI has opened an LC in favor of Deutsche Bank. So the bank has given the LC. The party has checked the terms of the LC. It's in order, and the seller has shipped that machine, and it has brought the proof of the documents, right? Bill of lading and all submitted to Deutsche Bank. Now what should Deutsche Bank do now? The question is, the officials of the bank, that is Deutsche Bank, should visit the port to verify the goods have been placed on board within how many days? So the seller has submitted proof of documents. So within how many days Deutsche Bank should go to the port? What is the deadline? Within how many days Deutsche Bank should go to the port and verify whether the machine has been shipped or not, right? The answer is none of the above. So we discussed already. Banks don't deal with the underlying transaction is not relevant to the bankers. Banks deal only with the documents, right? All the bank is concerned is whether the party has shipped the machine and what is the documentary proof for it. Thus, once the seller gives the documentary proof to the bank, there ends the matter. The bank will not physically go to the port and verify with the port authorities, with the shipping agency, whether the machine was actually shipped or not. Banks won't do that, right? Banks, once they get the documents, it's done. So the answer is none of the above. Banks will never visit the port to verify, right? So answer is none of the above. So question number 13, use on spirit is applicable in which of the following LC, right? We spoke of the two different types of LCs, right? DA and DP. DA is document against acceptance, right? Here we get the use on spirit. This is document against payment. This is site LC, right? So the answer is DA. Okay. BG issued by SBI appears under the following head in its balance sheet. So in the balance sheet of SBI, so there will be liabilities and assets. Okay. So where will the BG issued by SBI to its customers, right, appear? So current assets or non-current asset, there will be current assets here, non-current assets here, right? Current liabilities, long-term liabilities and short-term liabilities. So where will this BG appear? So the answer is none of the above. Please recall we had a discussion on something called contingent liability. The BG and LCs, the non-fund limits, are contingent on some event happening. We don't know whether that event happens or not. Only if the event does happen, the question of invocation of BG or devolvement of LC arises. Only then the bank's liability will become funded in nature. Till that time, we don't know whether it's going to happen or not. So they won't appear anywhere. They appear in somewhere called the notes to account. Okay. Under the notes to account, there will be a separate section on contingent liability. There, SBI will be furnishing details of this contingent liabilities. Okay. In the balance sheet, in the actual balance sheet, it will not be appearing anywhere, right? So with that, we come to the end of this exercise. So in the next chapter, that is in chapter 10, we will start a discussion on ratio analysis.